Tengizchevroil, or TCO, operates as the definitive fiscal engine for Kazakhstan's sovereign balance sheet.
Right, and the scope of that engine is staggering. We are tracking exactly how a single joint venture acts as the structural foundation for an entire nation's macroeconomic reality.
This deep dive unpacks the Q1 2026 and year-end 2025 operational data. We will establish the physical constraints of extracting from a supergiant reservoir, map the revenue circulation through the domestic economy, and quantify the execution risks of their latest infrastructure expansions.
Exactly. The reports we are analyzing give you a clear, data-led blueprint. It removes the abstraction from foreign direct investment models and shows the actual mechanics of a localized mega project.
To understand the structural conditions making TCO so legible to global investors right now, you have to look at the fiscal transfers. TCO has generated about $214 billion in direct payments to Kazakhstan since 1993.
Which firmly establishes it as the single largest revenue engine in the country. And, that is an ongoing active metric.
Right. It is not just historical data.
No, not at all. In Q1 2026 alone, the direct payments hit roughly $1.7 billion. And that figure includes taxes, royalties, KazMunayGas distributions, local procurement, and employee salaries.
So when you see a number like $214 billion, that is not just sovereign wealth fund accumulation. It is circulating capital directly stimulating the domestic market.
Absolutely. And the reason this demands active coverage right now is the Future Growth Project, specifically the Wellhead Pressure Management Project, or FGP-WPMP. It is the crucial next production step.
Because once that expansion hits full capacity, the impact on export revenues is massive.
Structurally transformative, yes. But that volume relies heavily on the Caspian Pipeline Consortium export route. That single corridor dependency is essentially the primary sovereign risk here.
Yeah, the CPC Chokepoint. We will definitely drill into that. But despite that specific vulnerability, the overarching FDI context is vital. TCO's operational model serves as the definitive template for structuring resource sector deals in frontier markets globally.
It does. It is the prototype.
So let us break this down into 5 key insights from the source data. Insight 1 is the ownership architecture.
Right, the cap table.
Yes. The finding here is that the equity split perfectly balances Western operational control with sovereign participation. The evidence for that is the specific allocation. Chevron holds 50%, ExxonMobil 25%, the state-owned KazMunayGas sits at 20%, and Lukoil holds 5%.
And the strategic significance of that structure is critical for investors to grasp. It secures Western capital and ultra-deep technical expertise while maintaining minority Russian exposure.
It was essentially the 1993 Nazarbayev-Chevron agreement prototype, right?
Exactly. It proved that frontier assets could be unlocked with a hybrid sovereign and supermajor model, which transitions directly into the scale of the asset itself.
Yes. Insight 2, field scale as a sovereign asset.
The finding is that the physical volume of the reservoir acts as a tangible sovereign guarantee. For evidence, look at the recoverable reserves. Tengiz and the smaller Korolev field hold 1.4 billion metric tons of recoverable crude.
Which is an immense volume.
It is. The total resource base at Tengiz alone is 3.1 billion tons. But the specific metric to emphasize here, the one that really highlights the scale, is that by 2021, they had already produced 4 billion barrels since the 1993 inception.
Wow. 4 billion barrels.
Yeah. The strategic implication is that a multi-decade operational runway like that provides unparalleled long-term visibility. It fundamentally underpins the country's sovereign credit profiling.
So you have a massive underground asset, but extracting it over decades forces technological upgrades. Which brings us to Insight 3, the FGP Expansion Bet.
Right. And the finding there centers on the inherent execution risk of next-generation infrastructure. The sheer capital weight of this upgrade is historic.
The final investment decision was made back in 2016, right?
Yes, leading to one of the largest single capital investments in the history of the CIS region, but it came with well-documented delays and cost overruns.
Complex engineering 4 kilometers underground tends to do that.
Exactly. But the data point to emphasize for Insight 3 is the labor mobilization. At peak construction, this expansion employed 90,000 Kazakhstanis.
Wait, really? 90,000 on one project phase?
Yes. It is a staggering labor force. So the strategic significance here is the constant tension investors must weigh. You have massive national output unlocks on one side, balanced against the execution risk premium of managing a workforce the size of a small city.
Which naturally leads to Insight 4, the CPC Chokepoint, because all of that newly unlocked volume has to reach a market.
Right, and this is the fundamental vulnerability in the architecture. The finding is that the asset's output exits almost entirely via the Caspian Pipeline Consortium to Novorossiysk.
It is a severe single-route concentration.
Exactly. You have the vast majority of a nation's fiscal engine relying on a single pipeline corridor in a geopolitically active region.
That feels like a structural risk that global allocators have to heavily price in.
They do. The strategic significance is clear. You evaluate this exactly like infrastructure choke points in other emerging markets. Think about, Vietnam's operational fixes required for their FTSE reclassification.
Oh, that is a great comparison.
Yeah, you have a massive economic engine, but it is ultimately constrained by a single external operational variable.
Moving to Insight 5, we see how the joint venture embeds itself domestically. Insight 5 is Kazakhstani content as an operating condition.
This is a crucial distinction. The finding is that local procurement is a strict contractual operating condition. It is not an optional CSR initiative.
Right. The evidence in the Q1 2026 data shows about $370 million spent on local goods and services in just that 3-month window.
And cumulatively, we are looking at $52.6 billion injected directly into local enterprises since 1993.
That completely reshapes the domestic industrial base.
It does. Plus, you have the Egilik program running in parallel. It has delivered over 120 social infrastructure projects backed by a $25 million annual budget.
So, the strategic significance is that managing local content and funding community infrastructure is fundamentally tied to maintaining the operational license. It is a core operating expense, not charity.
Precisely.
So we have established the 5 key insights. Let us pivot to the direct investment implications. How does this specific data map onto different investor profiles?
Let us start with private equity and infrastructure funds. The scale of that $52.6 billion local spend creates massive secondary asset supply chain opportunities.
Because they can target the specialized logistics, metallurgy, and manufacturing firms that service TCO.
Exactly. They are buying into the ecosystem. Now, for corporate investors, the focus is KazMunayGas. KMG's 20% stake creates a direct equity value linked to TCO's production milestones.
And what about the development finance sector?
There are significant ESG-aligned co-investment opportunities there. Development banks can scale investments alongside frameworks like the Egilik program or co-finance the environmental mitigation tech that TCO is deploying.
I imagine global asset managers and fixed income investors are looking at this from a much broader macro perspective.
Absolutely. Global asset managers view these multi-billion-dollar fiscal transfers as the underlying bedrock for Kazakhstan's sovereign rating.
Right.
And for fixed income investors pricing debt, sovereign spreads are directly tied to output continuity. Any potential FGP commissioning delays directly impact those spreads.
Let us crystallize the downside then. What are the 3 specific risks that all these investor profiles must price in?
Number 1 is the CPC route concentration we discussed. Any physical or geopolitical disruption to that pipeline is an immediate, severe liquidity event.
A complete bottleneck.
Yes. Risk number 2 is FGP execution risk and any further commissioning delays. Pushing timelines back defers the revenue unlocks.
And the third risk?
Currency depreciation, specifically KZT to USD exposure.
And we really need to emphasize the historical movement here.
Yeah.
The Tenge moved from roughly 450 to 536 against the US dollar between 2023 and late 2025.
Exactly. That is a significant depreciation cycle that foreign investors must hedge against.
So to navigate those risks, what are the 3 specific signals investors should track over the next 12 to 18 months?
Signal 1 is the FGP commissioning milestones. You are specifically looking for the announcement of first oil from the new processing trains.
Because that proves the execution risk is finally retiring.
Precisely. Signal 2 is the KMG IPO free float levels and international allocation. Monitoring how much equity the state actually floats indicates their willingness to open the sector.
Right, that makes sense.
And Signal 3 is the National Bank of Kazakhstan's rate trajectory. You want to see a sustained move below 16%. That signals domestic liquidity stabilization and better conditions for local supply chain financing.
So to synthesize this entire framework, the next 12 to 24 months will ultimately determine whether the future growth project successfully shifts this multi-decade asset into its next high-volume phase.
That is the core dynamic, yes. Active coverage of this asset is absolutely warranted for anyone looking at the region.
Because you are looking at an operation that has already transferred $214 billion to the state, sitting on massive, multi-decade reserves, and actively executing an export ceiling expansion.
Right. And it leaves you with a profound structural question. If a single localized operation can drive this much national modernization, workforce upskilling, and technological transfer over 30 years, what happens to a nation's broader economy when it successfully exports that heavy industrial expertise to entirely new, non-oil sectors?
That is the ultimate test for the region's long-term economic transition. Subscribe to Deep Dive Central Asia for more analysis on emerging markets and investment trends shaping the region.